Hello, I'm Robert and welcome to my channel where I talk about everything automated algorithmic trading or simply algo trading. If you've been following my Patreon or even my past videos, you know that I have been discussing and talking about research that I have been conducting for the last 2 years. That is what this video is going to be on, but specifically Bitcoin from 4 different exchanges, where I've conducted an analysis of which take profit and stop loss is the most profitable. Now I have these exchanges ranked from highest liquidity and trading volume to lowest. So let's start with the 4 choices. First one is KuCoin. Second one is MEXC. Kraken, which is the second to the lowest volatility and liquidity, and Poloniex, which is the very bottom. And we will see very shortly why that is. First, let's get down to the summary report. Here it is. The highest winning trading approach took in 51 wins with 9 losses. The take profit was 1%, the stop loss was 4%. But if you look at the second entry, there's not much of a difference, but it has half the risk with a stop loss of 2%. And it actually had a few more winning trades and a few more losing trades. There's not much difference in the winning trades, but as you can see, the losing trades is almost 3 times as much. So the considerations here between your risk and your reward become substantial. I personally like the higher winning to losing ratio because that is more sustainable over the long run, but that may not be best suited for your personal strategy. So you need to take that into consideration as you examine these results. And you can see that the third choice, 1% to take profit, 3% to stop loss, only brought in about $6.80. Now this is the highest liquidity and trading volume exchange that I did in this analysis. And I chose the 1 hour time frame because all of these exchanges support that, and it is reasonably comparable in terms of the actual trades. So now let's take a look at the second exchange, MEXC. Get down to the summary report. As you can see, the profit is quite similar, even though the winning trades versus the losing trades is slightly different. And you can see here that the take profit was 1%, the stop loss is 2%. So this coincides with the first exchange in terms of a correlation of volume. This is what you expect to see between exchanges that have similar volume and trading liquidity. Realistically, you should expect to see similar profits as well. So now let's move to the third exchange, Kraken. Now this is on the USD pair, not USDT, but it should be similar enough to give a reasonable correlation because the framework of analysis is about liquidity and volume, not about an individual stable pair or fiat-based transaction system. It will have some differences, but not what you would expect as a larger whole. looking at this table, we see that the winning trade had 31 wins, 8 losses, take profit of 1%, stop loss of 2%, but the highest profits were $5.68. But the key factor here is 3 different exchanges have take profit and stop loss that are the same. That is important. And now let's take a look at the last exchange, the one with the lowest volume and liquidity, Poloniex. It only made a profit of $2.27 with 9 winning trades only. It had no losing trades, but the fact that it had so few winning trades is a concern if you're looking for rapid trading. Take profit of 1%, stop loss of 5%. You can see that this exchange requires a larger stop loss to work with. But you can see by going down a little further, the 1%, 2% actually did well. 15 trades and 4 losses. This is comparable to the other 3 exchanges we saw, but the volume for the amount of trades we did is absolutely horrendous. And that is really a concern if you want to trade on this exchange. You're not going to get a large amount of trading volume. And remember, this is the 1 hour time frame. It's worse when you start going down in smaller time frames. But nonetheless, we have comparable results across 4 different exchanges. 1% take profit, 2% stop loss is good enough to take this analysis into a paper trader or a forward testing scenario where we can actually see how well it will hold up over a live market. And that is the whole point of what this data is about. Being able to get a reasonable take profit and a reasonable stop loss that will weather the market. So let's go back to KuCoin. I've opened up a few windows to talk about some of the various actual trades that took place. And that's what we're going to talk about now. How do the actual trades really look with this type of a statistical analysis? So let's get to the first table. 1% take profit, 4% stop loss. And that is exactly what this report shows. Now, you see my balance at the top for the simulation is $1,000 with 2% per trade. That means a $20 position. The 1 hour time frame, which lasts 62 days and 11 hours. My reward to risk ratio is 0.25. My win to loss ratio is 5.67. Now let's look at the actual trades. This is a simulation, position per position of market data that shows when it purchases and when it sells. How much it's sold for is the P&L column, the balance, and then how long did I hold that trade. As you can see, some trades took 3 days, some trades only took a few hours. So this is really how we get to see just how well the take profit, stop loss, correlation translates with each other on a simple process as simply buying whatever the market price is. No technical analysis is used in this process. None. Whatever the market price is, it's purchased and it's held on to until it either wins or it loses. And then the next trade is taken, 2% of whatever the balance is, and you can see that as the profits begin to compound. For example, the first trade is a take profit. The second trade is a stop loss. You see under the balance level that the balance went down. So let's go down to the table and get to the bottom, and you'll see that we took a total of 60 trades, 51 winners, 9 losers. We made a profit of $7 in 62 days and 11 hours. Realistically, this is a good strategy. Now let's see what the next report brings. The 1% take profit, 2% stop loss. Remember, it had a profit level that was very similar to the previous report. It has a lower win to loss ratio, but it still manages to do very well. So let's get to the bottom report. 84 trades, 63 winners, 21 losers, $7.02. Also for a duration of 62 days and 11 hours. All of these trades, through the correlation of take profit and stop loss, are 62 days and 11 hours. That is what this time frame represents in terms of duration. And you can see through the date time column exactly how that plays out, and through the duration column how long you will hold on to your trades. Some trades as high as 4 days, some trades only for 1 hour, because this is using the 1 hour time frame. So let's see the next table. 1% take profit, 3% stop loss. Again, the complete listing of all the data, trade by trade. Let's get down to the bottom and see what it shows. 64 trades total, 53 winners, 11 losers, $6.82. That's not bad. And now finally, the 1% take profit, 5% stop loss. Now all of these are the top 4 of the table I showed you to begin with. 43 trades total, 38 winners, 5 losers. And you can see some of these are a little higher for holding before they either profited or made a loss. Now let's take a look at a 1-to-1 ratio. Very simple, 1% take profit, 1% stop loss, wins to losses are 1.25. Again, each and every trade the process took. It made a total of 133 trades, 74 winners, 59 losers. And it only made $3. It did horrible. So a 1-to-1 reward to risk ratio is an absolute nightmare. Now let's take a look at a take profit of a reward to risk ratio of 2 to 1. So a 2% take profit, a 1% stop loss. We see all of the trades. Looks quite good, or so we think. Now let's get to the totals. 75 trades, 32 winners, 43 losers. It only made a profit of $2.13. That is a far cry from the $7 that were made at the highest level. So let's go to the next one. Maybe it'll get better. Here we do a 3% take profit, 1% stop loss. So a reward to risk ratio of 3 to 1. But we could already see from the win to loss ratio, this is not good. And in fact, lo and behold, it lost 28 cents. 56 trades, 17 winners, 39 losers. Not good. So 3 to 1 didn't do well at all. 2 to 1 made money, but it didn't do as well as previously shown of the 1% versus 2% stop loss. Next one is a 3% take profit or a 2% stop loss, or a reward to risk ratio of 1.5 to 1. The win to loss ratio is 1. Basically, this says it broke even. But let's see what happens at the bottom. It made money, $2.7 profit, but nothing like previous versions. So this at least kept us in the green. But 62 days for $2 isn't that great. Let's keep going. Okay, here is a 4 to 1 ratio. 4% take profit, 1% stop loss. All of the trades, and let's get down to the results. 42 trades, 10 winners, 32 losers, and it lost 87 cents. Horrible, garbage system. 4% take profit, 2% stop loss. A reward to risk ratio of 2 to 1. Well, we saw that a 2% take profit, 1% stop loss at least made a little money. So maybe this will have some hopes, but we can see that the win to loss ratio is below 1. So that suggests it lost money. Let's see. No, it actually profited $1.98. It made less money than the 2% to take profit, 1% to stop loss, but it still actually made money even though it lost 17 trades and only won 10. To me, this is not a sustainable approach, though. And finally, a 4% take profit and a 3% stop loss, or a reward to risk ratio of 1.3 to 1. This did well with a win to loss ratio of 1.12. That's barely above water, but it still shows signs that it made money. Let's see. 17 trades, 9 winners, 8 losses, and it made $2.77. Let's keep going with some different models to see just what we can get out of this data. Okay, let's look at a really unusual situation. A take profit of 26% with a stop loss of 8%. This is definitely not something you're going to normally find. but it made a 1-to-1 win-to-loss ratio, and it's a 3.25-to-1 reward-to-risk ratio. Let's look at the trades. It only took 2 trades in 62 days, but those 2 trades brought $3.51. And both of them took place. The first one was a stop loss after 30 days. The second one was a take profit after 28 days. So as you can see, higher levels of take profit require higher levels of market exposure and higher levels of risk. But this is an unusual case where using this approach will mean less trades, but you're going to be profitable. It's a strange situation that's part of a risk to reward combination that as you trade, you have to make these kinds of decisions. I personally would not use this because it does not fit my trading style, but it's certainly something that needs to be looked at because it really did shine for the fact that it only made 2 trades. Okay, let's wrap this up with looking at this table some more and really taking a look at some of the more unusual trades that this table shows. So let's go down, and as you can see, the table clearly shows, with a few unusual cases like the one we just looked at, that a lower take profit versus a higher stop loss is going to be statistically more profitable. Now you're going to get a few outlining cases like a 20% take profit versus an 8% stop loss. That is absolutely insane. But it worked. And that's what this research is really about. Finding the really strange cases that just don't make sense, but still brought home a good profit. And there are actually quite a few. For example, a 27% take profit versus a 5% stop loss. It only had 1 winner and 2 losers, but it still made money because it took less risk, because 5% stop loss is less risk than an 8% stop loss. Here's one, 23% take profit versus 6% stop loss. So you're going to find a lot of interesting cases by looking at this data and examining it and seeing just where this information really leads. It is quite fascinating, particularly when you're working between different exchanges, because this data from one exchange actually does correlate very well with other exchanges that have similar trading volume and liquidity. So if you're into arbitraging, that can be a critical point to work with, because you have an expectation then of similar price action at the level of your take profit and your stop loss. %22 take profit, 6% stop loss. Here's one, 12% take profit, 8% stop loss. Some really unusual numbers I would have never expected or even thought of trying without this type of advanced simulation and analysis. Granted, the profitability is not that good, but if you're only doing 2 trades, that really is phenomenal for just 2 trades. And of course, you can see the 1-to-1 risk-reward ratios don't bring in very much either. even though you're making an insane amount of trades. 74 trades for 59 losses. Excuse me, 74 wins, 59 losses. Only $3.02. You're better off with just 4 trades and no losses with a 3% take profit, 12% stop loss, and taking less risk overall on the basis of your profitability. But if you're going to use a 1% take profit, think about the consequences of using a tight stop loss. And that really is the point of this research. This research shows, without a doubt and beyond question, if your stop loss is too tight or less than your take profit, statistically you are going to take more losses than wins, and you're actually going to hurt yourself in the long run for your profitability. The top 5 cases all show a low take profit, a higher stop loss. Even when you go below that, you can see, for example, 2% take profit, 3% stop loss. 2% take profit, 5% stop loss. It's only until you get down to the $4 mark that you see the first situation. Actually, no, I take that back. I looked at the wrong numbers. It shows a smaller take profit to a larger stop loss. Let's see where the flip actually begins. Okay, we have a 1-to-1 ratio at 5% take profit to 5% stop loss. It brings in $3.61. But every case prior to that I can see, and I'm checking to make sure I didn't miss any numbers, shows lower take profit, higher stop loss. So let's keep going. All the way down here at $3.51 with this unusual outliner case of a 26% take profit, 8% stop loss. But that's not something that's going to be consistent in the market. It only makes 2 trades. That's not going to carry you long term. What's going to carry you long term and is sustainable is 50 or 60 trades versus 9 to 20 losses. A significant difference between your wins and your losses. That is the sustainability. The closer your wins to your losses, the less sustainable your trading approach becomes. And that really is the whole point of what this research drives home. If you want to make money in the market, you need to give your stop loss room to breathe. Examine the market, examine the numbers, run the simulations, and then decide from there. For me personally, if I was to use this approach, I would personally choose the 1% stop loss, 1% take profit, 2% stop loss. Simply because there's less risk involved and there's not much difference in profitability. But if there's a case, for example, looking at the 3rd and 4th situations, that's significant enough that I would choose the higher profitability over the number of losses. 11 losses is pretty steep, but 5 losses might be better even though you're not getting the wins. But again, you have to look at the trade-offs. You have to look at the situations that determine whether or not a given take profit percentage correlates to a stop loss percentage on the basis of your personal risk. So let me know what you think about this information. How does this information help you with your trading? or does it actually help you think about a different approach as it did me? In terms of my own trading, where I generally don't use stop losses, this is giving me some information that I honestly didn't even realize. And I would have never thought about a 26% take profit as an outliner situation. So let me know what you think. Also, let me know what combination of trading pairs you'd like to see tested next. Any pair that has, or any exchange that has an open API, I can collect information on and examine. Perhaps Ethereum or XRP? Let me know in the comments. Share your thoughts. If you found this video useful, please give it a thumbs up and like it. Hit that notification bell if you want to be notified for my next videos. And rest assured I will be putting a lot of these out over time as I continue to examine the market and learn all the real secrets. And the real secrets is very simple. What we've been taught about stop losses being tight or kept very small is a lie. The math says otherwise. The analysis says otherwise. If you want to make money, a small stop loss compared to a small take profit compared to a larger stop loss. It's counterintuitive at first thought, but when you think about the laws of statistics, it makes sense that smaller take profits are going to be triggered more quicker than larger stop losses. Just like it also makes sense that if you have a small stop loss, that's going to happen more frequently than a larger take profit. So statistics proves yet again the manipulation that large institutions have been doing over the years to con you out of your money. This information shows you how to really make money in the market. That's not to say you will, but this gives you the potential. This gives you the information you need to make informed decisions about your personal trading. So, hit that thumbs up, and until next time,